So, you've put your money to work with savings and investments. That's the smart move. But now for the tricky part, right? Figuring out how all those new earnings are actually taxed. Let's get into it.
It seems like a pretty simple question, but the answer? Well, it's surprisingly complicated. See, the tax system doesn't treat all your investment returns the same. The income from your savings account is taxed totally differently than the dividends from a stock, and that's different again from the rent you might collect.
So what are we even talking about here? The official term you'll hear is property income. Just think of it as the passive return you get from owning something. It could be money in a GIC, shares in a company, or a rental condo. It's the profit that comes from your assets working for you, not from you actively working.
Okay, to really get a handle on this, we're going to break it down. We'll kick things off with the rules for interest, then we'll solve what I like to call the dividend tax puzzle, we'll look at renting out property, and then, at the very end, we'll put it all side by side to see how they stack up.
First up, interest income. You know, the money you earn from things like savings accounts or bonds. When it comes to interest, the biggest question the tax man asks isn't how much you made, but when you have to report it. It's all about timing.
Now, this is where things get kinda interesting. For corporations, the rule is super strict. They have to report interest as it's earned, pretty much day by day. But for individuals like you and me, it looks like we get a choice. Report it when the cash is in your hand or when it's legally yours. But is that choice really as flexible as it sounds?
Well, not so fast. That so-called choice comes with a pretty big string attached. It's a rule that's specifically designed to make sure you can't just put off reporting that income forever and ever.
And here is that string. It's called the anniversary day accrual rule. It basically overrides everything else and says, look, no matter what, you have to report the interest you've earned at least once every 12 months from the day you made the investment. The bottom line? Any tax deferral on interest has a strict one-year time limit.
Let's walk through a quick example to see how this plays out. Imagine on February 1st, you make a 2-year loan. By the end of that first year, nothing's been reported. But then, boom, January 31st of the next year hits. That's the 1-year anniversary. The rule kicks in. You have to report all the interest from that first 12-month period. The rest gets reported when the loan is finally paid off. It's a perfect example of how the system stops you from kicking that tax can down the road indefinitely.
Okay, on to our next topic, dividends. This is the income you get as a shareholder when a company decides to share its profits. Now, the tax treatment here is a completely different beast than interest, and it's all designed to solve a very specific puzzle about fairness.
And that puzzle really starts with this one question. Why the super special treatment? Well, unlike interest, which is an expense for the company that pays it, a dividend is a piece of the profit that has already been taxed once at the corporate level.
And that's what creates what we call the double taxation problem. Just look at the flow here. First, a company earns some profit and it pays corporate tax. Then it uses what's left to pay you a dividend. And then you have to pay personal income tax on that same money. So the same dollar of profit gets taxed twice. That doesn't seem quite right, does it?
So to fix this, the tax system came up with this really clever two-part mechanism. The entire goal is to weave the corporate and personal tax systems together, so that in theory, that $1 of profit only gets taxed once, at your personal rate.
Part 1 is called the gross up. Now this sounds strange, but you don't actually report the cash amount you received. Instead, you report a higher, grossed up amount. The idea here is to estimate what the company's profit was before it paid any corporate tax. It's the first step to unwinding that double taxation.
And that brings us to part 2, the dividend tax credit. So after you calculate the tax on that higher, grossed up amount, you get this special credit. Honestly, the best way to think about it is like a rebate. The government is basically giving you a credit because it knows the corporation already paid some tax on that profit. It's how the whole system balances out in the end. All right, let's move on to our third and final category, rental income. This is the profit you make from renting out real estate like a condo or a basement apartment. And the big story here is absolutely the power of deductions. But of course, they come with some really important limits.
Unlike interest and dividends, rental income is treated much more like a business. You report your gross rent, and then you get to subtract all your expenses to find your net taxable income. We're talking property taxes, insurance, repairs, mortgage interest, and a really huge one is something called capital cost allowance, or CCA. That's just the tax system's fancy term for depreciation.
But, and this is a big but, here comes the first major rule. While you can deduct all your real cash expenses, you can only claim that capital cost allowance, that CCA, to bring your rental income down to zero.
You absolutely cannot use it to create a loss that you then use to lower the tax on your other income. The government is saying, sure, you can depreciate your building, but not to the point where you're generating a loss on paper.
Now, there's another really big rule that affects landlords, and it all comes down to this one number, $50,000. Keep that number in your head. So why does that $50,000 figure matter so much? Because any rental building you buy that costs more than that has to be put into its own separate depreciation category. This rule basically guarantees that when you eventually sell that building, all the depreciation you claimed over the years gets added back into your income in the year of sale. It's a way to make sure you can't just defer the tax on those deductions forever.
Okay, so we've covered a ton of ground, right? We've talked interest, dividends, and rentals. Let's pull this all together now and do a little side-by-side comparison to see how these three really stack up against each other.
This table, I think, makes it all so clear. You can really see the different philosophies at work. For interest, the big challenge is timing, and the solution is that anniversary day rule. For dividends, it's all about avoiding double taxation, which is solved by the gross-up and tax credit system. And for rentals, it's about making sure you can't create artificial losses, which is handled by those CCA restrictions. Each system is totally custom-built for that specific type of income.
So why does all of that matter? Because the way your investment income is taxed has a direct impact on your final after-tax return. Getting your head around these rules, knowing, for instance, that dividend income is often taxed at a much lower rate than interest, or knowing the strict limits on rental losses, that is absolutely crucial for making smart financial decisions.
And that really leaves us with one last thing to think about. Now that you know the rules of the game, I want you to take a look at your own portfolio. Is it built more on interest, dividends, maybe rental income? Knowing the rules is always the first step to playing the game well.